Kunal, to you, and I'm now hearing, and for a while now, fairly contrasting views on the credit growth opportunity and versus what can actually happen. Because when you speak to a clutch of alternate offerers, right, you speak to private credit funds and they say that companies are borrowing from us, banks are not able to lend them or lending them, and therefore the credit growth that used to be the forte of banks in the yesteryears will probably not be as strong. I would love to know, how do you think about this? Because now we are waiting for this elusive big bank credit growth to come in the private banks. Isn't quite there.
Yeah. So since last 1.5 years, we have been highlighting that credit growth in India, it should be maybe over next couple of years should range between 13 to 14 odd %. And I think what's really driving down the credit growth was the industry credit or the corporate credit, and that's still growing somewhere in mid single digit to maybe a high single digit kind of a number. It's moving towards high single digit, but still much below the overall average credit growth. Retail has been something which has driven the credit growth. Of late, we have seen moderation on the unsecured lending post the increase in the risk weights which have been there. And if you look at this quarter's earnings, everyone has moderated the pace of unsecured. So that's something which is cooling off. Another segment which was growing at a much faster pace, which was banks lending to NBFC. That is also, it's now growing at maybe almost like 5 to 7 percentage points lower than what the average has been. So all of this is really pulling down the credit growth, and that's where, if we look at the latest numbers, now it's come down to 13 to 14 odd %. And if we adjust for HDFC Limited, then it's closer to 15 odd %, compared to maybe 16 to 17 odd %, which has been there all through. So what can actually drive again is the corporate credit. We need to see the investment activity picking up. Still, when we look at it on the corporate side, it's largely working capital which has driven the demand. It's not more of the investment activity which has maybe driven the corporate credit as such. And the other constraint is on the resources front. Yeah. So deposit growth has been lagging, and now we are seeing most of the lenders, they are anchoring their credit growth targets in terms of how they are able to mobilize the resource. And it's not only about the availability of the resource, but the cost at which they are able to raise. And since there is a clear focus with respect to margin management, I think somewhere we have seen many of the lenders going relatively slow on the credit side and more looking at high yielding, high ROA kind of opportunities rather than getting into the segments which are relatively low ROA accretive.
Interesting. So just one quick follow-up there, because I was talking to ABB and they were saying that hitherto, while the new age sectors had come in and driven CAPEX, they see the turn of the metals, the cements, maybe not cement as much, but metals and some of the traditional sectors now starting to get on the CAPEX bandwagon. Do you sense that private CAPEX finally makes a comeback? Is that the strategy?
So see, there are a couple of things there. We did put out a couple of notes on this topic. So firstly, private CAPEX is not really as slow as some people suggest. There are pockets where it's doing well. However, it's not as broad-based as, and then what happens in particularly in this segment is people tend to compare it to the prior cycle, right? Which was like very kind of prolonged and very strong. So this is definitely not like that. This is like more narrower in certain pockets, and at an overall pace, it's consistent and decent, but it's slower than what, say, 2006 to 2010-11 was. So that's how I would characterize it. It's there. It's been there. Last year was also decent, but again, it's there in certain segments rather than being very broad-based in nature.
So in which case, Kunal, if it's not so broad-based, do private banks get the growth that the market wants them to be? Or even if they grow at the pace at which they've been growing, would you believe there could be stock price gains? What are your favorites? What's the first amongst equals within the private banking space?
So when we look at it, private banks have continued to outpace the overall industry credit growth, and we had seen them gaining the market share at the cost of PSU banks. But incrementally, when we look at it against the expectation which would have been there, say 12, 15 months back, we have cut down the growth estimates for a few of the leading private banks. If you look at it in terms of the consistent performers, it's like ICICI, which has been relatively more consistent, and that continues to be our top pick. So in terms of the preference, we still believe like ICICI can do well on the growth relatively better. And in terms of the preferences, we have HDFC and IndusInd Bank as well, not from the growth perspective, but overall with respect to where the valuations are.
But sticking to the large banks.
Yeah.
Sticking to the large banks.
Yeah, sticking to the large banks.